Hello everyone, welcome to the 91st episode of Forex. So in the last episode we went through how to trade Forex on news releases, basically looking at which news events are even worth trading, and then familiarizing ourselves with key event risks that heavily impact the major currencies. So the news that tends to drive price action and produce volatility usually involves central bank policy, government policy, economic data releases, and random tweets from a certain world leader. How to find events that produce volatility? Well, we can use the economic calendars. They should be able to tell us like which sort of events have like a high, medium, or low impact on the currencies you're looking at. And also some events usually relate to the changes in interest rate, inflation, economic growth, like retail sales, manufacturing, and consumer sentiment. Some examples, and depending on what's currently happening in the world, the relative importance of this event may change. Pay special attention news from the US, and also look at the US stock market. Also pay attention to the geopolitical news. Choosing the currency pairs to trade the news. So basically all the major currency pairs. And yeah, now we're on to two ways to trade the news. So two ways to trade the news. 31st. Let's get started then. Two ways to trade the news. There's no single strategy for trading the news. When the news hits, the price tends to spike in one direction or has muted reaction to the data as traders digest the outcome against market expectations. Knowing this, there are two main approaches to trade the news. Having a directional bias, having a non-directional bias. So two ways to trade the news. Having a directional bias and having a non-directional bias. Directional bias. Having a directional bias means that you expect the market to move in a certain direction once the news report is released. So bias means you expect the market to move in a certain direction once the news is released. When looking for a trade opportunity in a certain direction, it's good to know what it is about the news reports that will cause the market to move. So when looking for a trade opportunity in a certain direction, it's good to know what it is about the news that will cause the market to move. We're all excited to hear from analysts who are bullish on the market. Consensus versus actual number. Several days or even weeks before a news report comes out, there are analysts that will come up with some kind of forecast on what numbers will be released. As we talked about in a previous lesson, this number will be different among various analysts, but in general there will be a common number that a majority of them agree on. This number is called a consensus. When a news report is released, the number that is given is called the actual number. Consensus. Forecasts which analysts come up with. Forecast which analyst comes up with for an upcoming news report. Forecasts which analysts come up with for an upcoming news report. A common number forecasted by analysts for a common number forecasted which analysts generally agree with for an upcoming news report. Actual, the number actually reported in the news. Buy the rumor, sell on the news. This is a common phrase used in the Forex market because oftentimes it seems that when a news report is released, the movement doesn't match what the report would lead you to believe. So when the news report is released, the movement doesn't match what the report would lead you to believe. The movement doesn't match what the report would lead you to believe. For example, let's say that the US unemployment rate is expected to increase. Imagine that last month the employment rate was at 8.8% and the consensus for this upcoming report is 9%. With a consensus at 9%, it means that all big market players are anticipating a weaker US economy and as a result a weaker dollar. So with this anticipation, big market players aren't going to wait until the report is actually released to start acting on taking a position. They'll go ahead and start selling off their dollars for other currencies before the actual numbers are released. Now let's say that the actual unemployment rate is released and as expected it reports 9%. As a retail trader you see this and think, okay, this is bad news for the US, it's time to short the dollar. However, when you go to your trading platform to start selling the dollar, you see that the markets aren't exactly moving in the direction you thought they would. It's actually moving up. What the heck? Why? This is because the big players have already adjusted their positions way before the news report even came out, and may now be taking profits after the run-up to the news event. Now let's revisit this example, but this time imagine that the actual report released an unemployment rate of 8%. The market players thought the unemployment rate would rise to 9% because of the consensus, but instead the report showed that the rate actually decreased, showing strength for the dollar. What you would see on your charts would be a huge dollar rally across the board because the big market players didn't expect this to happen. Now that the report is released and it says something totally different from what they had anticipated, they're all trying to adjust their positions as fast as possible. This would also happen if the actual report released an unemployment rate of 10%. The only difference would be that instead of the dollar rallying, it would drop like a rock. Since the market consensus was 9% but the actual report showed a bigger 10% unemployment rate, the big players would sell off more of their dollars because the US looks a lot weaker now than when the forecasts were first released. It's important to keep track of the market consensus and the actual numbers. You can better gauge which news report will actually cause the market to move and in what direction. It's important to keep track of the market consensus and the actual numbers. You can better gauge which news reports will actually cause the market to move and in what direction. It's important to keep track of the market consensus and the actual numbers to better gauge which news reports will actually cause the market to move and in what direction. Non-directional bias. A more common news trading strategy is the non-directional bias approach. This method disregards the directional bias and simply plays on the fact that a big news report will create a big move. It doesn't matter which way the Forex market moves, we just want to be there when it does. What this means is that once the market moves in either direction, you have a plan in place to enter that trade. You don't have any bias as to whether the price will go up or down, hence the name non-directional bias. Non-directional bias means you don't care which way the market moves or which direction the market moves. You have a plan to enter anyways. Cool. So how to trade the news with a directional bias. Let's now see how to trade the news with a directional bias in a trading scenario. Let's go back to our example of the US unemployment rate report. Scenario: if the US unemployment report showed improvement, why did the USD still weaken? Earlier we gave examples of what would happen if the unemployment report came in light with expectations or slightly better. In this scenario, let's say that the unemployment rate showed a surprising drop. So there's less unemployed people now, which is a good thing since that means more people now have jobs. But you look at your charts and the dollar is falling. What? Isn't the dollar supposed to rise if unemployment rate is dropping? There could be a couple of reasons why the dollar would still fall even though there are more people with jobs. Reason number one, overall economic outlook still poor. The first reason could be that the long-term and overall trend of the US economy is still in a downward spiral. Remember that there are several fundamental factors that play into an economy's strength or weakness. Although the unemployment rate dropped, it might not be a big enough catalyst for the big traders to start changing their perception of the dollar. Number two, positive employment numbers are temporary. Perhaps it's right after Thanksgiving during the holiday rush. During this time, many companies normally hire seasonal employees to keep up with the influx of Christmas shoppers. This increase in jobs may cause a short-term drop in the employment rate, but it's not at all indicative of the long-term outlook for the US economy. A better way to get more accurate measure of unemployment situation would be to look at the number from last year and compare it to this year. This would allow you to see if the job market actually improved or not. The important thing to remember is to always take a step back and look at the overall picture before making any quick decisions. Now that you have the information in your head, it's time to see how we can trade the news with a directional bias. Take a step back and look at the overall picture before making any quick decisions. How to trade the news with a directional bias. Let's stick with our unemployment rate example to keep it simple. The first thing you would want to do before the report comes out is to take a look at the trend of the unemployment rate to see if it has been increasing or decreasing. By looking at what's been happening in the past, you can prepare yourself for what might happen in the future. Imagine that the unemployment rate has been steadily increasing. 6 months ago it was at 1% and last month it topped out at 3%. You can now say with some confidence that jobs are decreasing and that there is a good possibility the unemployment rate will continue to rise. Since you are expecting the unemployment rates to rise, you can now start preparing to go short on the dollar. By looking at what's happened in the past, you can prepare yourself for what might happen in the future. Yep. This is your directional bias. Since you're expecting the unemployment rates to rise, you can now start preparing to go short on the dollar. This is your directional bias. Particularly, you feel like you could short USD JPY. Just before the unemployment rate is about to be announced, you can look at the price movement of USD JPY at least 20 minutes prior and find the range of movements. Take note of the high and low that's made. Take note of the high and low that are made. This will become your breakout points. The smaller the range, the larger the tendency there is for a volatile move. Take a note of the high and low that are made. This will become your breakout points. So after a decision, after a directional bias has been made, take note of the high and low for the 24 take a note of the high and low at least 20 minutes prior to the report, to the news being released, and take note of the high and low of the range of movement at least 20 minutes prior to the news being released. These will become your breakout points. The smaller the range, the larger the tendency there is for a volatile move. Since you have a bearish outlook on the dollar, your directional bias, you would pay particular attention to the lower breakout prior to of that range. Pay special attention to the breakout point depending on the direction. Right, okay. You are expecting the dollar to drop, so a reasonable strategy would be to set an entry point a few pips below that level. So here's a dollar, USD versus JPY. Set your entry point a few pips below the lower breakout point. So this is the range. Shouldn't the range come up, or is it only looking at this pit from above? Breakout point here, breakout point here, so set your entry point around here. You could then set a stop just at the upper breakout point and set your limit for the same amount of pips as the breakout point range. Target should be 18 pips below lower breakout point. Set stop at upper breakout level. Yep. Range is 18 pips. Target should be 18 pips below lower breakout point. Your target should be around here. One of the two things could happen at this point. If the unemployment rate drops, then the dollar could rise. This would cause USD JPY to rise and your trade would most likely not trigger. No harm, no foul. Or if the news is as you expected and the unemployment rate rises, the dollar could drop, assuming the entire fundamental outlook on the dollar is already bearish. This is good for you because you already set up a trade that was bearish on the dollar, and now all you have to do is watch your trade unfold. So target should be 18 pips below the lower breakout point. Yep. Set stop at upper. Yep. This is still 18 pips. Yep. So enter the trade around here, and then it went down. Your trade was triggered and your target was hit. So it hit here, trade stopped. Bada bing, bada boom, 18 pips in the bag. Later on, you see that your target gets hit. You just grabbed yourself a handful of pips. Booyah. The key to having a directional bias is that you must truly understand the concepts behind the news report that you plan to trade. Right, okay. To have a directional bias, you must truly understand the concepts behind the news report that you plan to trade. If you don't understand what effect it can have on particular currencies, then you might get caught up in some bad setups. You need to understand what effects it can have on the currency. How to trade. How to trade the news using the straddle trade strategy. What if there was a way to make money quickly even if you had no idea whether the market would move up or down? It's possible as long as there is sufficient price volatility. And when can you get this volatility? When news like economic data or central bank announcement is released. The first thing to consider is which news reports to trade. Earlier we discussed the biggest moving news releases. Ideally you would want to only trade those reports because there is high probability the market will make a big move after their release. The next thing you should do is to take a look at the range of at least 20 minutes before the actual news release. The high of that range will put you in the upper breakout point, and the low of that range will be your lower breakout points. Note that the smaller the range is, the more likely it is you will see a big move from the news reports. Wait, now I think about it, I should probably so gimme note that the smaller the range is, the more likely it is you will see a big move from the news report. Yep. The breakout points will be your entry levels. This is where you want to set your orders. Your stops should be placed approximately 20 pips below and above the breakout points, and your initial targets should be about the same as the range of the breakout levels. Yup. Let's go here. Okay, like that. Straddle trade. This is known as a straddle trade. You are looking to play both sides of the trades. Straddle trade looks to trade. Straddle trade looks to play both sides of the trade. It doesn't matter which direction the price moves, the straddle strategy will have you positioned to take advantage of it. So, it's like a mirror basically. We got our same graph here, this bit here. We don't really have a directional bias, so we don't really care if it goes up or down. Entry points, we got our highs and lows. Whoa. Entry points above the high and below the low. So there are our highs and lows are the breakout points, and our entries are above the high and below the low. Our target should be about the same as the range of the breakout points, so this should be about 44 pips, and this should be about 44 pips as well. What else? Stop for the long trade should be 20 pips below the upper breakout point. Yep, so stop level should be around here, so that in case it doesn't go up and it drops down instead, the stop triggers and stops the trade. For the short one, when shorting it, stops should be 20 pips above the lower breakout points. So if it doesn't go down and instead goes up, then it stops the trade as well from losing too much money. Yep. So this is when you place that trade where like you can place two trades at the same time, and if one trade gets triggered then the other one doesn't go ahead with it. So it only goes out with one of the trades. Now that you're prepared to enter the market in either direction, all you have to do is wait for the news to come out. Sometimes you may get triggered in one direction only to find out you get stopped because the price quickly reversed in the other direction. However, your other entry will get triggered, and if that trade wins, you could recoup your initial losses and come out with a small profit. A best case scenario would be that only one of your trades get triggered and the price continues to move in your favour, so you don't incur any losses. Either way, if done correctly, you should still end up positive for the day. One thing that makes a non-directional bias approach attractive is that it eliminates any emotions. You just want to profit when the move happens. This allows you to take advantage of more trading opportunities because you will be triggered either way. As most news events tend to have a limited impact on longer term price action, setting realistic profit targets should help to increase the number of winning trades. There are many more strategies for trading the news, but the concepts mentioned in this lesson should always be part of your routine whenever you are working out an approach to take advantage of news report movements. Summary: trading the news. Whoa. Trading the news. When trading the news, you can either have a directional bias or non-directional bias. Here are some other things to keep in mind when news trading. When you have a directional bias, you're expecting the price to move in a certain direction and you've got your orders in already. It's always good to understand the underlying reasons why the market moves in a certain direction when news is released. When having a directional bias, you are expecting the price movement price to move in a certain direction, and you've got your orders in already. It's always good to understand the underlying reasons why the market moves in a certain direction when the news is released. When you have a non-directional bias, you don't care which way the price heads, you just want to get triggered. When having a non-directional bias, you don't care which direction the price moves. Setups for the non-directional bias are also called straddle trades. Setups for the non-directional bias are also called straddle trades. That's pretty much it. Is it really that easy? Heck no. You'll have to practice and trade many different reports before you get a feel for which news reports will make the market move, how much of a surprise is needed for the market to move, which reports to avoid trading. Like in any other trading methods, your success depends on your preparation. This will take time and practice. Do your homework and study the economic indicators to understand why they are important. Remember, nothing worth having comes easy. So stick with it and you'll find that trading the news will be very rewarding once you get the hang of it. True. Nothing worth having comes easy. True. Practice and trade many different news reports to get a feel for which news reports will make the market move, how much of a surprise is needed for the market to move, which reports to avoid trading. Quiz time, trading the news. Extra, news reports can spark movements in the currency markets, and volatility is a trader's best friend. Do you know enough to trade these situations safely? Let's go. In the stock market, trading on information that has not yet been released to the public is more generally known as insider trading. Which of the following is an advantage of trading the news? Is an advantage potential spike in volatility. Slippage occurs when there is an extreme volatility causing you to get filled at a far different price in your order. Yep. Which of the following economic reports typically sparks the most volatile reactions from the markets? Most volatile reactions from the market. NFP stands for that something payroll, doesn't it? CPI, Consumer Price Index, unemployment claims, PPI. What is PPI? I think I saw it before somewhere. PPI. Here we go. Most important CPI, PCE, PPI. NFP, right? Okay. Which of the following pairs would probably give you the most hiccups when trading the news? Most hiccups. GBP CAD, because it doesn't have the USD in it, which is because this isn't a major pair, isn't it? So it can't be that. Before a news report is released, the generally accepted forecast figure for the report is known as the consensus. True or false? Taking a non-directional bias means putting orders both above and below the current price. True. Let's say you want to trade the news on USD/JPY and you have a bearish outlook on the pair. It has been trading within a tight range of 20 pips before the news. Where should you put your stop loss exit orders? You have a bearish, so you want the price to go down above the upper breakout points. Let's say you want to trade the NFP reports and are bearish on the dollar, so you want to go down. You want to trade the Euro USD because it has been trading within a tight range of 20 pips just before the report. Where should you put your entry orders? Just below the lower breakout points. Huh? Is it not that? When taking the straddle trade, where would you put your entry orders? Simultaneous orders at market. Oh, never mind. True or false? When taking straddle trade, you should always aim for 20 pips. Depends on the range of the breakout points. True or false? One advantage of the non-directional bias approach is that it helps eliminate emotion. True. I thought the wait, let's just say insider trading price, that's NFP, CAD, consensus, true, stop loss above the upper breakout. Right, okay. Just before the report, where would you put your entry orders? Bearish on the dollar. You want to trade it's been trading within a tight range of 20 pips. Is that market? You're bearish on the dollar anyway. What? It's above the thing. It can't be. When taking a straddle trade, where would you put your entry orders? Buy orders just above the upper breakout and sell orders just below. Yep, okay. Depends on the range. True. How to trade and use with directional bias. So you put it on above the, if you're going bearish on it. No, but you put an entry below the lower breakout point though if you're going bearish on it. Why is it upper? Yeah. I don't know. But it can't be though. I don't understand. Skip all this price. Like that. NFP, CAD, consensus, true. Above, not this one. This one. It's just above the upper breakout point. Yeah, but your entry orders though. Why is it the upper breakout points? Shouldn't it be below the lower breakout point if you want it to go bearish? Yeah, I don't know. Yeah, okay, let's just move on. So what is the carry trade? 31st03. Oh, that question is really bugging me now. I don't really understand why it's above if you're going bearish on it. Because look in this diagram. The bearish, you want it to go down here. So you place your entry order below the lower breakout point, not above the upper breakout point. So I don't know why. I don't know. Anyways, what is the carry trade? Did you know that there is a trading strategy that can make money if the price stayed exactly the same for long periods of time? Well, there is, and it's one of the most popular ways of making money by many of the biggest and baddest money manager mama jammers in the financial universe. It's called the carry trade. I'm tired of carrying this. What is a carry trade? A carry trade involves borrowing or selling a financial instrument with a low interest rate, then using it to purchase financial instrument with a higher interest rate. So a carry trade involves borrowing or selling a financial instrument with a low interest rate, then using it to purchase a financial instrument with a higher interest rate. While you are paying for the low interest rate on the financial instrument you borrowed or sold, you are collecting a high interest rate on the financial instrument you purchased. So your profit is the money you collected from the interest rate differential. The profit comes from the interest rate differential. carry trade example, let's say you go to a bank and borrow $10,000. Their lending fee is 1% of the $10,000 every year. With that borrowed money, you turn around and purchase a $10,000 bond that pays 5% a year. What's your profit? Anyone? You got it, it's 4% a year, the difference between interest rates. By now you're probably thinking, that doesn't sound as exciting or profitable as catching swings of the market. However, when you apply it to the spot Forex market, with its higher leverage and daily interest payments, sitting back and waiting, watching your account grow daily can get pretty sexy. To give you an idea, a 3% interest rate differential becomes 60% annual interest a year on an account that is 20 times leveraged. Damn, so pretty much you can increase your account by over half. Leveraged carry trade example. Let's say you borrow $1 million at an interest rate of 1%. The bank won't just lend $1 million to anybody though, it requires cash collateral from you, 10,000. You get it back once you pay back the money. Your loan is approved, so fill up your backpack with cash. Then you turn around, walk across the street to another bank and deposit the $1 million in a savings account that pays 5% a year. A year passes, what's your profit? You earned 50,000 in interest from the bond, because it's 1 million times 0.05. You pay 10% in interest because it's 1 million times 0.01. So your net profit is 40,000. With a measly 10,000, you earned 40,000. That's a 400% return. In this section, we'll discuss how carry trades work, when they will work and when they will not work. We'll also tackle risk aversion. With WTH is that, don't worry, we'll be taking more about it later. Okay. Very good. I'm going to leave this episode here. In the next video, we're going to carry on with carry trades, with what is a currency carry trade. So thank you all for watching this episode. Bye!